So to solve one thing, to solve IRR or internal rate of return, you must have known how to use a net present value, because the format is same. The only difference between IRR and net present value, for IRR you are usually not provided with a percentage or a rate. So it's you to identify, and you are concerned how to you will identify a rate at which, when you compute net present value, is going to give you a figure which is zero or closer to zero. Hope that's clear. Where we are concerned about determining net present value, that will be at what rate are we going to get net present value, zero or closer to zero. That's what is meant by internal rate of return. So on this particular question, we'll come up. Okay, already you already have the question, the PVIF table. So I'd like one of you to suggest a percentage. I'd like one of you to suggest a percentage. Then we do compute and see if it does not give us zero, net present value of zero, then we'll take another percentage. So the table is still same. We'll have here year or period or year, cash flow, then PVIF, IF. Who is suggesting the PVIF that we want to use? And then NPV. So somebody to suggest for us what percentage you want us to use. Anybody to suggest for us a percentage that you like us to use?
10%.
You said 10%. Come up again, Abraham. We use 10%.
Yes.
Okay, at 10%. So we'll use 10% as Abraham has suggested. PVF 10%.
Sir,
Yes?
are we just like randomly picking any percentage?
Yes, for IRR, we take randomly a percentage. Yeah?
So that means if it is not working, what happens? You try another one.
You try another one.
What? Okay.
Yeah. So we will try until we get a percentage that's going to give us zero or a number closer in NPV, zero or closer to zero. Is that in order? So we start off with the period is 0 to 6. The period is 0 to 6. So we'll record here 0, 1, 2, 3, 4, 5, and 6. Then cash flow for year 0 was 40, 13, then 8. 40,000. And as usual, we said for year 0, it's usually negative because that's the year we are investing. We don't expect to start a business and start getting returns immediately. So it's usually negative because we are investing out. Then year 1, 13, then 8. 13,000 here. Then 8,000. Then 14, 12, 11. 14,000, 12,000, 11,000. Then the last year, the last is 15,000. So now you read for me the PVIF at 10%.
0.9091.
0.9091. Year 2.
0.64.
0.8.
8264.
8264.
264.
You are able to see what I'm writing, huh?
Yeah.
Yeah. So I hope I've written the correct figure.
Yes.
The third one?
0.7513.
0.7513.
13.
The fourth one?
0.68.
68.
30.
30. The fifth one?
0.26209.
Just a minute, let me erase that. I started writing to 0. So you said
6209.
09. The last one?
0.56.
0.56.
45.
45.
Yes.
Okay, thank you.
Welcome.
So now we want to fill in the NPV. You probably can also allow another candidate, another trainee to respond. Who is taking over from there? So that we fill in now NPV. So for year 0, automatically will be negative 40,000. Year 1, who is giving us the figure? Hello, class, are we there? To get PVIF, we multiply cash flow. To get the NPV, we multiply cash flow against the PVIF. So who is giving us the figures?
11,000
11,000.
818.3.
818.3. The next one? The next one?
A minute.
Okay. Other members can also
6,000.
chip in.
6,000.
Yes?
I said
6,611.2.
6,611.2. The third one? The third one?
10,000.
Said 9,000?
10.
10,000. Just a minute, I erased that. 10,000.
518.2.
518.2. The fourth one.
800. Oh,
Yeah.
8,000.
8,000. 8,000.
196.
196. That 6 is not clear. Just a minute. I read. Let me erase that. 8,196 points.
No point.
No points. Okay. 0. The next one. The fifth one.
6,000.
6,000.
829.
829. Does it have a decimal?
Yeah, 0.9.
0.9. We move on to the next one. The last one.
Gosh.
8,000.
467.
267.
400.
It's 467.
Yeah.
Just a minute.
0.5.
Just a minute. I erase that so that I write. So 8,467.
0.5.
0.5. So we add. Okay. Add those values.
$52,000.
Okay, you said 52,000.
441.
Did you start with the negative 40,000?
Oh no, sorry. Let
Yeah,
me
you start with
deduct
the negative
first.
40,000.
Yep. So it's 12,441.1.
Yes, sir.
12,441.1.
12,000.
441.1. Bye.
441.1. So, because we chose 10% and it's giving us a positive figure, now we need to choose a higher percentage so that it gives us a lower NPV. And that lower, we remember our target is to get NPV 0. So our target is to get NPV 0. So for this first one, we have gotten our NPV, which is 12,441. So we choose another higher percentage. Who would like to give us a percentage that you'd like us to use? You can suggest a percentage.
16.
We do 16%.
Yeah.
So now with the 16%, I wouldn't do the much of writing because now you have mastered the concept of what you do. So you have on column 1, we have year, we have cash flow. We have cash flow. Just a minute. Somebody's. Okay. Derek, you have your hand is up. Derek, your hand is up. Do you have something to say? Derek? Okay. Derek is not responding. Okay, you have unmuted. Tell us something. You have a question? Okay. Derek, you're not talking to us. So we are going to PVIF. IF 16%. So because you have the table, I'd like you to compute, to fill in that information and only record NPV. I'll only record NPV. So a computer will give you, yes?
I'm asking how do we find the present value interest factor?
There's a table I shared last week. Were you present in last class last week?
Yeah, but I left earlier.
Yeah. Though there's a table I had shared before even class. I shared in the morning, you are to print last week. That's the table members are using. Yeah?
Yeah.
You have seen it, huh?
Yes, I have the table.
Yeah, so from that table, that's why we are reading the PVIF.
Okay.
Yeah.
How? Maybe
you have that table?
It's not printed. Maybe you'll share. I will have someone show me later. Let's continue.
Yeah, because if we had it printed, then I will have given you the instruction. But on the table, there's a percentage. On the upper top level, there's a percentage. Then on the extreme left, there's a period. So you just go to where there's that percent. Like now, you are looking at 16%. You go to where there's 16%. And then you read as it is. The values that are there, you just enter into the table we have created. Then we multiply.
Okay, thank you.
Okay, welcome. So I'm allowing you 2 minutes. You do it in your books at 16%, and then you give me the NPV. So it's currently 27 minutes past 6. So at exactly 29 minutes past 6, I'll be requesting for answers from you. Umerekebisha ni gani? Hapo tuko hiyo page. Hapo ni kisako nilikuwa nakuambia utoe fanya. Nilisako you delete. This is an abstract. Abstract you don't tell us. So you will not go. I will not give you other correction. But now this is what I will use. At least nikikupatia 30 out of 100, at least unajua mahali nimetoa, si ndio? You don't indicate. Okay. Guide yenye nilikupatia, the first paragraph should talk about section 1. The second paragraph about section 2. The third paragraph about section 3. So, but you are not to we just put in there titles who are not necessary. So, so I will go back to that next. Fungua hii page. Nimekuandikiaje? Umeiweka? Si bado umeacha tu hiyo section 1 hivyo tu. Si ndio hii document ama ni? Hujaweka, si ndio? So hapa hujaweka, hapa hujaweka. Hapa hujaweka. Hii nimekuambia uweke center na hujaweka center. Unajua kuweka document center? Lakini hii si center. Hii umeweka tu na space. Ukiweka senti inakuja exactly katikati ina balance. Sawa. Hapa nilikuwa nimekuambia avoid one statement paragraph. Alafu hii inamaanisha nini?
It's not specified the trainer. It's not, the trainer has not been specified because we normally carry out training with different people.
So now when you are preparing a report, because you are preparing what you have encountered, not what you are going to encounter. So it has to be specific, measurable, achievable, realistic, and time bound. So if you leave it blank, then it's not conclusive. This is wrong. Umefanya HR, ndio? So if you have that two people are supervising one, and it's not even two people, these are departments. Two departments are supervising one person. You see, this is a HR business partner. That's okay. But this is a
Carpentry and hardware.
carpentry department, hardware department. No, organization structure does not have departments. It don't have office holders. Yeah, so they should be office holders. Hello, are you done?
Yes.
What did you get as your NPV?
It's 4,143.
4,000?
143.4.
1.4. It's not a negative?
No, it's not.
It's not. That means at
Yeah.
16% we are not yet closer to zero. So who else?
Yes.
Yes. Who else is getting another percentage that we can use?
I've tried 20%.
20%. And what have you gotten?
It's giving negative 278.1.
Yeah. So negative
It's giving
200.
negative 278.1.
217.1.
Yeah.
So have you tried with the now 19%?
No, maybe I try that.
Try with the 19% and see.
Okay.
Yeah. If it doesn't have 19, try 18. 18 is there. Yeah, you try 18. You can do 18.
Pia 18 haiko.
Just a minute, I get a calculator, I show you, I demonstrate to you how you can still get the PVIF using a calculator. And I hope you are using scientific so that it's much easier for you to use. Just a minute.
Hey, sir. Hello. There's no 19%.
Yes.
Okay, sorry, I was retrieving my calculator so that I demonstrate to you the PVIF. Other than using the table, we can still use the calculator to get the PVIF. So, just a minute, I open the PVIF table, then I show you how to use it. Now, if you look at the table where there's PVIF, there's a formula I've been given. Where there's PVIF, you have been given a formula 1 divided by, so you can divide by, we open the bracket, in your calculator open the bracket, once I've opened bracket, it's 1 plus, let's say if you want to do 19%, so 19% will be 0.19, 0.19. We close the bracket, then it's power 1, power 2. So for power 1, for the first year is power 1. Power kuna what's until calculate, just a minute, I see the power. Yeah, and then, okay, for you to get power, let me put video on so that you are able to see whatever we are doing on calculator. Just a minute. I believe you are able to see my calculator. So
No.
now, yeah, you are able to see the calculator, though you cannot see the figures on it. So
No, we
this is
can't.
what I've said. Yeah,
You can't see the calculator. Oh, yeah.
you are able to see.
Yeah.
Now on the calculator, we want to calculate the PVIF, and we want to calculate at 19%. So for us to calculate PVIF at 19%, we do 1, press 1, then press divide by. Then after pressing divide by, you open the bracket. It's 1, then plus 19%. If we convert into decimal, is 0.19. So that will be plus 0.19. Then we close the bracket. After closing the bracket, kuna hapo ni kwa on scientific calculator kuna kaka kona arrow face juu, so you press on that, it gives you the power. So for year 1 we'll do power 1, then okay, so we get 0.
Mwalimu,
Yes,
inside the bracket, it is 1 plus
plus the percentage.
19 exactly, or 19 or over
It's
100%.
19%. It's 19%, but you can convert into decimal. You just put
Oh,
0.019.
Thank you. Thank you.
Then now power 1. You have done that. You have done that.
Yes.
What figure have you gotten?
0.8403.
36. But let's use 4 decimal places. Huh?
Mm.
So it will be 0.8403. Then for year 2, we still use the same process. Huh? For year 2, we still use the same process. So we still do 1 divide by, open the bracket, 1 plus 0.19, close the bracket, power 2. Power 2. What's the answer? What's the answer? What's the answer? Hello, are you stuck? Hello? Kindly share if you are either you are stuck or if you have the answer, share so that we finish, we move on to the next item that we need to discuss. Joyce, are you able to calculate for year 2?
Yes.
Okay, you have gotten how much?
1.4161.
No, it cannot be 1 point. It
Power
should not give you 1 point. It should be 0 point. So
Wait,
you have
Papa.
not done it. Kariuki, you have seen your message. You have not understood the concept. Do you have your calculator, Kariuki? Confirm so that we do together with you. So Kariuki, so we are doing with you. We are doing for year 2 because you have already done for year 1. Huh? On your calculator, dial 1. Then divide by, open bracket, 1 plus, remember we are doing PVIF at 19%. So 19% is equivalent to 0.19. So plus 0.19. Close the bracket. On your calculator, if you are using a scientific calculator, there's a nini kitu kanakaa kama inverted V. Oh, that's Abraham, you don't have a calculator, so okay, you have gotten the concept, but you don't have a calculator, okay, Abraham. But we will do with the Lorraine Karaoke. You have a calculator, but you have not gotten concept. So on your calculator, there's an inverted V. That inverted V, press that button after closing the bracket. And then, because you are doing for year 2, press 2. That is power 2. Then answer. What's the answer?
7
0 point?
706.
Yes, 616. So
Yeah.
because we are using 4 decimal, then we round off to 4. We need to be 0.7062. Lauren, confirm you have gotten the concept. Okay. So Lauren, I expect you to give us the answer for year 3. For year 3, the process will be same. You do 1 divide by, open the bracket, 1 plus 0.19, close the bracket, power 3. Power 3. So, Lorraine, you can share your answer if you have gotten the concept. Can share your answer if you have gotten the concept. Lorraine, kindly share your answer so that we confirm you have gotten the concept. We don't want to leave anybody behind. Anybody who has already gotten the answer, you can share.
Yes.
Mm-hmm.
Power 3.
Yeah?
It's for power 3.
Yeah, for power 3.
0.5934.
3, 4. Thank you. We do for year 3, year 4 now.
Zero 0.4987.
0.4987. At least you have gotten the concept. Now, the next one?
0.4190.
And the last one?
0.3521.
Now, okay. Now, can you calculate? Now, calculate the NPV. Calculate NPV and share your response. Anybody who is stuck, kindly don't, because with online I cannot see whatever you are doing. Hata wale wako jikoni mnaweza kuwa mko jikoni, hatuwezi ona. But if you are stuck, kindly unmute, share with us or send message so that we are able to assist you before we go far. And then for those who don't have a calculator for today, remember this finance mostly we don't have much time, so that's why I will not dwell much on theory part, but we'll give much emphasis on calculation so that you get the concept, because that's the main area that will come. So daily ensure you have the calculator with you so that it's easier. You can also follow up with the class. Okay, so who is getting us the NPV? What have you gotten?
$756.
756. That's a positive. Huh?
Yeah.
I remember at 20, it was a negative. Huh?
Yeah.
So now in that case, it means that our internal rate of return is between 19% and 20%. Our internal rate of return is between 19% and 20%. Now, for IRR, usually for exam purpose, you may not be given 2 or 3 projects to assess and advise on which one to choose. you will only be given one project, then you are asked to calculate the IRR for that particular project. Now, for a practical situation or for industry, how you will use IRR, we usually use this method to evaluate and see if at all it's viable to invest in that particular project or not, especially after computing the cost of capital. And that's what we want to do. Well, the topic we are moving on now will be cost of capital. Now, if at all you are going to borrow money from a bank and the bank is going to give you at 22%, and you have computed your internal rate of return is between 19 and 20%, will you still go ahead and borrow that money to invest in that particular project as a prudent investor, as a rational investor? If you are borrowing money from a bank at 22% and the project is likely to give you between 19 and 20%, will you still go ahead and borrow and invest in that project? You can get your reactions. Abraham, if at all the bank is giving you a loan at is 22%, and you want to invest in last week, most members suggested that we do tree planting, agroforestry, and agroforestry is promising you a return of 19 to 20%. Will you go ahead and borrow money and invest in that particular project?
For me, I will not, because still,
yeah.
For me, I will not invest in projects.
Yeah.
Because still, it's way below the expected interest.
Okay. For Abraham, will not. Any other member? Joyce? Will you go ahead and borrow that money and invest in that project? Lauren? Any member who would like to share his or her view, will you go ahead and borrow and invest in that particular business? So if other, thank you, Lauren. Lauren have said no, since it will go at a loss, yes. So we don't invest in that. So that's what we consider when you are making decision. So in that case, we usually use internal rate of return to evaluate and see how much are we going to get from the project. Then we can compare with the cost of the financing that particular project. If at all the cost is higher than our rate of return, then we don't invest in that particular project. But if at all our return is higher, for example, if you are going to borrow at 12% or 12%, then you can take that particular loan, because you know, even if the return you get from the project will be adequate to pay a cost of your capital and also provide some few shillings to take care of the administrative costs. So in that case, that's how we use the internal rate of return. So any question pertaining to investment appraisal before we move to the next topic? Any question pertaining internal rate of return?
I have a question.
Yes, Abraham.
Yeah, I was having an internet problem. Can you repeat the last statement?
Yeah. You are having, Abraham?
An internet problem.
Yeah. So the last statement, I'll repeat what I've said. We usually use, just a minute. I know there's a lot of background. Okay. Sorry for that. So I'll repeat. This is what I've said, that for purpose of examination, IRR, you may not necessarily be given several projects to compare and make decision on which particular project to invest in, because of the trial and error nature that we have done. We try, if it doesn't work, you go to the next percentage. So if you have given multiple of projects to make decision, it might consume most of your time. So mostly for IRR, you'll be given one project for the purpose of exam. But now for the purpose of industrial or to practice, natural practice, we use IRR to make a decision on which investment to make. And I've given an example that if at all you are borrowing money from a bank, then you have to calculate the IRR of that particular project and compare with the interest rate that the bank is charging. If at all the interest rate is higher than the IRR, then you don't invest in that particular project, because the cost of financing that project is higher than the return that you are going to get from that project. But if the cost is lower, for example, our IRR was between 19 to 20%. If at all we are going to borrow from a bank at 14%, then we can go ahead and borrow at 14%. Then we invest in that particular project because we know we'll get 19%, which will be adequate to take care of our return and also take care of administrative costs. And then, yeah, so we'll be able to take care of our returns and also take care of our administrative costs, and then whatever remains. So that's how we use IRR. I hope I'm clear now with you, Abraham.
Thank you. Yes.
Okay, so any other question before we move on to the next part? If there's none, we can move on to the next part. Now, what I would like you to look as an assignment, what I can give you as an assignment for further reading, you can try and get advantages and disadvantages of those methods that we have evaluated. You can try and look at advantages and disadvantages of those methods, and then that will have taken care of that particular topic. So we have covered one topic so far, 9 more to go. So we move on to the second topic. Now, on this second topic, we want to invest in a business. So as we want to invest in a business, we want to get money. So we have identified a project. We have identified a project using the methods that we have already covered, but we want to get money. Where can we get money to invest in this particular project? Any member to give us any source of revenue, source of capital that we can use to invest in a particular project?
You can borrow a loan from a bank.
Very well. You can borrow from a loan from a bank. Another one? Another one? Loan from a bank. Another one? Hello. You have never started off a business, or you have never seen somebody who has started a business, or you have never known where people can get money to start off a business.
Can also get from friends.
You can get from friends, very well. Let's mention all those sources. Then I will take some few minutes to explain them. Then we do whatever we want to cover for today's lesson.
From family members.
Okay, we have contribution from friends. Someone has mentioned family members. Somebody has said sale of assets. Someone had mentioned loan from bank.
You can use your savings.
We have personal savings. Another? Another one?
You can as well get money from a SACCO.
Loan from
Loan
SACCO,
from a SACCO.
yes. Loan from SACCO.
Can also apply for grants. I don't know
You can
if
get
that is
grants. Another source? Class, you only know of this 1, 2, 3, 4, 5, 6, 7. You only know of 7 sources. Any other source? Okay. So now, because you have mentioned whatever you can remember, I will take you through some of those contents. Now, when we want to start off a business or run a business, the sources of finance or the sources of capital are usually classified into two, and you cannot note them down. The first, we'll start off with the first classification, which is short-term source. Short-term source. And when you talk of short-term, these are the monies that we expect to use for a period less than 1 year. We are getting this money and we are utilizing, and we have to repay back within a period of 1 year. So we don't have them for a very long period of time. And then the second category will be long-term sources. Now, for the long-term sources, we expect to use this money for a long period of time, usually longer than 1 year. It can run to a span of 10 years, and we look at them. So let's start with the short-term sources. The first one is commercial papers. Commercial papers. Now, when you talk of commercial papers, those are the agreements. For instance, I could have okay, let's say a scheme could have gotten into agreement with the company to supply us some resources on credit. So we have not paid that particular company. So because we have not paid the company, but we have given a commitment letter that we are going to pay for this money. Now that company, because they also require supplies, they can use that commitment letter that Kim has given to source to get money or to get their supplies. They can give them as a security that Kim has promised they have committed they are going to pay us this much on this particular date. So if we allow to give them money. So we refer to that as a source. So in that case, we are getting from the documents that we do have. And that's what we are referred as commercial papers that are within the transaction. Then number 2, we have bank overdrafts. Bank overdrafts. Yeah. It's not your spirit. Changanye. Yes. And so the bank overdraft, this is the money, for instance, you only have 10,000 in your account and you have written a check of 30,000. So the bank will pay for you the 30,000, but now they expect you to pay back to the bank within a short period of time. So we refer to that as a bank overdraft. So it's only a short period. And remember, for you to access that facility, you must have gotten into agreement with the bank that the amount of money that they can grant you as an overdraft, so that you also, they don't grant you as an overdraft and then you decline to pay because you don't have an agreement. You must have signed an agreement with the bank for you to have that facility, overdraft facility. And then the next one, still under short-term, we have short-term bank loans. Short-term bank loans, these are the loans that you take from a bank and you expect to repay them within a short period, usually less than 1 year. You go to a bank and negotiate with the bank, give us 200 million or 2 million, we'll pay within 6 months. For example, Kim, we want to prepare for an intake. So we can go to a bank, let's say in December, we can go to a bank and say we want to do renovation so that by January, we are able to attract more customers. So in that case, we can go to a bank and negotiate for a loan, but we know in January we'll have major intake, we'll get money, we'll pay back. So we just negotiate that we'll pay within a short period of 6 months. So in that case, that's also another source, but it's only short term for a short period. Then the next one is a promissory note. A promissory note. So now when you talk of a promissory note, this also a commitment or a show. I've promised that I'm going to pay you this money by a certain date. So I've only committed to pay you, or I've promised that I'll pay you money on this particular date. So if I've promised you, you can go ahead and supply me with the goods. So when you supply me the goods, that's a source of finance because I've already sorted that money. For me to get those supplies, it means that I must have paid cash. But now because I didn't have cash, I only promised you that I'll pay you cash. Then you offered the goods or services that I was needing. So it's also a source of capital, but it's also short-term in nature. Then we have what we also refer to as treasury bills. Treasury bills. Though in Kenya, mostly these treasury bills, they work with the government. For government, it can borrow money from the citizens for a short period. For instance, when government realize that there's a lot of money in circulation, and whenever there's a lot of money in circulation in the country, it's likely to drive inflation. So government can use this particular mechanism to withdraw money from the public, or from the economy, so that they control inflation. So they can offer a treasury bill. So treasury bill is money that government is borrowing from the citizens with a promise that they will pay with an interest on top of it. So that's also a source of capital for a business. Now, we also have bill of exchange. Bill of exchange. So now when you're talking about bill of exchange, the simplest example that most of us have interacted with is a check. It's a check. So if you have transacted with a check, that's a bill of exchange. So when I give you a check, or when you give me a check, it does not necessarily mean you have paid me. It's only an instruction that you are giving me to go and give a bank, or you are giving instruction to a bank to transfer money from your account to my account, of which that instruction can be honored or cannot be honored. So that check is also a source of capital that I can give you a check, which is an instruction that you will take to a bank. You give me the services or give me the products, but take this check, take this instruction to the bank. You take it to the bank, and the bank will transfer money to your account. And then in that particular scenario, we can also have the post-dated checks. Because I know I don't have money today, I can draw you a check and promise you that take this check to the bank probably in September or in the next month, which will be November. In November 15th, take to the bank so that they transfer money from my account to your account. So, but you'll offer me the services or goods that I was to get. So in that case, it's also a source of capital. Then the next one is letter of credit. Letter of credit. For that one, I would like you to ask one of you to explain, if you can give us the explanation for letter of credit. I know you have interacted with it much. Anyone who can explain for us letter of credit? Anyone who can explain for us letter of credit? Rebecca, I can see you are around. Have you ever encountered a letter of credit? Yes, go ahead.
No, I'm just Googling now, actually.
Yeah.
I've never interacted with it. Yeah.
So who else has ever
Yeah.
interacted with the letter of credit? Lorraine? Lorraine, you have interacted with the letter of credit? No. Okay, I'll give you. The letter of credit, it's usually, for example, if you want to import an item, mostly you may not feel comfortable because especially if somebody you have not transacted with, you may not feel comfortable to send money, to transmit money to that particular seller. So, and that seller will also not be comfortable to send the items or commodities to your end before you make the payments. So now what will happen is that you will go to your bank and your bank will write a letter to commit that you have money, and they will transfer that money to the seller immediately, depending with the agreement that you have made with the seller. That if at all the agreement is, once the seller dispatches the goods, he can claim for the payment, then the bank will write a commitment or a letter to show that they will transfer the money as long as they have been served with the documents to show that goods have been dispatched. Or if we had agreed that once the goods get into our side, then immediately the bank will effect that payment. So in that case, the bank will write the letter, and this letter it will be written to the supplier's bank. So for example, if Kim is operating a bank in the Barclays Bank and they want to buy some commodities, from let's say Caritas brand, and Caritas brand operate a bank in Equity Bank. So because Caritas brand may not trust Kim, so they will request Kim to go and get letter of credit. So Kim will go to Barclays and they'll give Barclays details for Caritas brand. So Barclays will write the letter to redirect into Equity Bank, instructing Equity Bank that yes, allow Caritas brand or authorize Caritas brand to dispatch those goods. Once they have been dispatched, the Barclays Bank will effect the payments to Equity Bank. So once they have written that letter, then Caritas brand will go ahead and transmit or send the goods to Kim. Then once Kim receives, they'll communicate to Barclays, then Barclays will also effect those payments. So that's what you are referring to, a letter of credit. Then we have hire purchase.
Mwalimu, sorry.
Yes.
Just a little, maybe if you can repeat it.
Yeah.
which one is issuing the letter? Is it the buyer or the seller? You're issuing to which bank?
It's the buyer instructs the bank or request the bank, his bank. And I've given an example in this case. If Kim is buying some commodity from Karatasi brand, so Kim will instruct their banker. So Kim banks have said it's ABSA. It's now called ABSA. So if Kim is operating a bank with the ABSA, and a Karatasi brand is operating a bank with Equity Bank. So Kim will instruct ABSA to write a letter to Equity Bank confirming that Kim are creditworthy. They can be given, if they don't have, even if they will not have cash, ABSA will know how to get money from Kim, but now they are committing, they can pay that money. So ABSA will write a letter to Equity Bank. Now, Equity Bank, once they receive that letter, they will confirm to Karatasi brand that they have gotten a letter from ABSA committing that Kim has ability to pay that money, so that Karatasi brand can now go ahead and supply those commodities. So once Karatasi brand has supplied the commodities, if the agreement was once the Kim received those commodities, they will effect the payment. Then now Karatasi brand will deliver the commodities to Kim, and Kim will sign a receipt, or we acknowledge a receipt of those goods. Once they have signed the acknowledgement for receipt of those goods, then that acknowledgement is what Karatasi brand will go to Equity and give them to show that they have actually delivered their part of bargain. So in that case, now Equity will follow up with ABSA to get those money so that they credit through Karatasi brand accounts. So the communication is between the banks, because the banks, they have their channel of communication, and they also have the trust that they have within themselves, the way they operate. So that letter of credit cannot be, for example, Kim cannot go and get that letter of credit from ABSA and take it directly to Karatasi brand. It has to be communication between the banks. It's only the banks which can communicate and agree. Then they instruct their customers. Is that in order now?
Yes, thank you.
Yes, sir, welcome. So we move on. We have hire purchase. Hire purchase, this is by hiring a commodity with the intention to purchase it. You are hiring a commodity with the intention to purchase it. Some of the old shops that have been offering this particular service is like Kenya Credit Traders, KCT. So KCT have been specialists in a hire purchase. So what happens, you go to this particular shop, then you agree you want to buy, let's say, a TV set. And the TV set is 30,000. So because TV set is 30,000, that hiring company will tell you, if you pay cash, you'll pay 30,000. But we can also allow you to pay installments for 1 year. But now if you are paying installment for 1 year, you will pay us 3,300 per month. 3,300 per month. So how much will you have paid at the end of the year? If they tell you to pay an installment of 3,300 per month, how much will you have paid at the end of the year? Anybody?
39,600.
Yeah?
39,600.
Yes. So they tell you if you pay cash, it's 30,000. But if you want to pay installment, they can give you the commodity. You have the usage. You start using the commodity, but you'll be paying on monthly basis 3,300. You get it? Now, once you have paid for the last installment, now they can give you a receipt ownership. So remember, when you are using hire purchase, you'll have the possession, but you don't have the ownership of that particular commodity. You are only having possession. So you can enjoy that particular commodity, but you don't have ownership. If at all you pay for the 10 months and you fail to pay the last 2 months, that hiring company will come and repossess that particular commodity. And now when they repossess, they will classify the amount of money you will have paid for the 10 months that you have paid 30,000, 33,000. That amount will be considered as a hiring charges. It will be considered hiring charges. You cannot claim for refund of that money. So that commodity will be repaired and returned on the market for resale. So if you don't pay the full amount to the last minute, even if you fail to pay one installment, they will come and repossess that commodity and resell it. And the amount of money you will have paid will be considered as a hiring charges. So you cannot claim to be reimbursed. So that's also a source of capital. You can, because you can hire a commodity and use it. So you, in that case, you have served you the same way you just have gone to a bank and borrow money and buy that particular item. So those are the short-term sources of capital. Any question pertaining to the short term before we move on to the long term? Any question or concern or feedback pertaining to the short term? Okay, if there's none, we move on to the long-term sources. Now, on the long-term sources, the first one, we have equity. Equity. Who can tell us anything about equity? Anyone? A volunteer? Any volunteer who can tell us something about equity? Oh, so today you are getting a lot of terms. Huh? You learn a lot of terms. Okay. Equity is also called ordinary share capital. It's also called ordinary share capital. So now these are the real owners of the business or the part owners of the business. So these part owners, they are giving you money to run the business on their behalf. Get it? So that's a source of capital. And probably this equity is usually referred as the highest single source of capital, especially when it comes to limited company. Most limited company, the biggest source of capital they usually get is what you are referring as equity. Yeah. So for them, because they are part owners of the business, they participate in decision making of the business every time and then any decision to be made in a business, they must be consulted. And they make decision by way of voting. They have to vote for any decision that management have proposed. Then the second one is rights issue. Rights issue. So when you talk of rights issue, these are shares, but they are given to people who have some privileges, or they're given to already existing shareholders. For example, if Kenya Institute of Management was a private company and they have shares, and they want to raise additional share capital, they can decide to give some priority to the existing shareholders because they don't want to dilute. They don't want to get new shareholders, because when you get new shareholders, they'll also come in with some challenges. So in that case, because we want to maintain our existing shareholders or share capital, so we can say we want to issue to existing shareholders a certain number of shares, and probably we can give them even some advantages. We can say if the current market rate is 10 shillings, we can decide to give them at a discount that they can only pay those shares at 5 shillings or 7 shillings, because they are already existing shareholders. But we give them a limit that if you have 1 share or 2 shares, for every 2 shares held, you can apply, you can qualify to get additional 3 shares, or can get additional 1 share for every certain number of shares that you hold, so that we don't dilute the shareholding. Now, when you talk of diluting of shareholding, it essentially mean that within the shareholders, the ordinary shareholders, we have them categorized as either major shareholders or minor shareholders. Now, when you talk of major shareholders, these are people who have the highest number of shares in the company. Now, those people as I have said, that they make decision through voting of company is not one man, one vote like the normal democratic processes in circles or the normal democratic processes in the country. For the shares, for the public companies, it's usually one share, one vote. So that means if I have 51% of the shares in a particular company, my one vote, my single vote is considered as a 51% of the votes. So that means I can sway decision of the company. So if we give outright issue, we don't want to dilute, we don't want to reduce that holding, because when we reduce that holding, then it means that other people will come up with divergent views, and those divergent views, they can work for the better of the company, or they can also work against the company. So in that case, that's why we issue the rights issue. We move on to another is bonus issue. Bonus issue. Now, when you talk of bonus issue, these are okay. At most, what arise on bonus issue, it means okay, when a company makes profit, they usually don't distribute the whole profit to the shareholders in terms of dividend. They usually retain some profit for their operation. Now, as they retain this profit, after some times, they usually have a colossal amount of money, a lot of money within their company that, to use in operation. So in that case, to convert this money, the retained profit, into ordinary share capital, so that nobody will claim that money. So they usually give out to the existing shareholders bonus shares. So these are the shares that are given to the shareholders without necessarily asking those shareholders to contribute even a single shilling. So the money will be obtained from the capital the profit that has been retained in the company. Remember, when the company makes profit, those profits are supposed to be distributed 100% to the shareholders in terms of dividend. But now in this case, if the company has not distributed this dividend, then they can go ahead and give out a bonus issue or bonus share. Then we move on to the next one, bonds stroke debenture. Bonds stroke debenture. Now, we'll discuss bonds and then we'll discuss debenture. So bonds, this is where specifically when government is borrowing from the public. When government is borrowing from the public, so they use bonds. They usually use bonds. And there's a bond that was talked much, was publicized much in Kenya sometimes back when Jubilee government took over leadership. Who can remind us that kind of bond?
Eurobond.
Eurobond, very well. Now, this Eurobond, it means government of Kenya was borrowing money from the public, but they were borrowing in euro currency, a currency called euro. Get it? Huh? That's why it's called Eurobond. So if government is going to borrow money in a currency called US dollar, we'll refer to that as a dollar bond. Dollar bond. So if the country or Kenya is borrowing in Kenya shillings, because that's our local currency, then we'll just refer to it as a bond or a Kenya shillings bond. So bonds, it's where government is borrowing from the public. Then debenture, now debenture applies when a public company is borrowing from the public. And I'll give an example. If today Safaricom wants to borrow 50 billion shillings, according to the laws existing in the country, there's no single bank that can loan out 50 billion. And even if those banks combine If they combine to give a loan, we refer to that as a consortium. But even if they combine, you will find that they may not afford to give out a loan of 50 billion to Safaricom. Yes, Safaricom can afford it, they can pay, they have the ability, but now those banks will not be able, because there are laws, there are controls, that a bank should not give to a single borrower beyond 5% of their loan book. So in that case, they can only raise small amounts, because their loan book, most of the banks, probably apart from KCB, Equity, and Cooperative, some of the banks have not even reached 100 billion in their loan books. Some of them are still below 100 billion. So in that case, if you are considering 5%, they can only give out a small amount of money. So in that case, even if all banks were to create a consortium, they will still not be able to raise 50 billion to give out to Safaricom. So in that case, because of the performance of Safaricom, they can decide to borrow directly from the citizens. They can decide that, yes, we are borrowing from citizen. Anybody, if I have my 10,000, I can contribute. You have your 50,000, you can contribute, and any other person can contribute whatever he has. Then they raise 50 billion. After that, they will be able to finance whatever project they want to do and be able to pay back. Now, with the debenture, once you have given this money to the company, the company will give you a document which is called a debenture document. So it's a certificate just to show you that they will pay you, and also detailing the terms and conditions. Now, for instance, have you heard of something called M Akiba?
Yes.
Anybody who has heard of M Akiba?
I have.
Anybody? You have heard? In which context? M Akiba, how does it work? How does M Akiba work? Yes, go ahead.
They have some loans that they give out with interest, say 10,000 with a certain interest, like that.
Yeah. So the M Akiba is actually a facility that government is borrowing from the public. That they tell you can lend as little as 5,000 through mobile phone, through, let's say, through M-Pesa. You just send M-Pesa to the government, and that they'll send you electronic document called the bonds. So in that case, after every certain period, if they said after 3 months or after 1 year, they'll give you interest. So you'll be earning interest, and then you, at the end of that particular period you have agreed, if they are borrowing for 1 year, at the end of the 1 year, they give you back your money. So for the period within 1 year, they'll be sending you your interest, but now after that period, they give you back your money. So that's what we are referring to, bonds or debentures. Then we have a lease or buy decision. Lease or buy decision. Now, when you talk of lease, it's basically you are hiring. It's like you are hiring this particular item. So you can hire. It could be a fixed asset, or it could be a fixed asset. Let's say like land and building, or you could be leasing machines. You could be leasing machines. So when you lease, you are hiring for a long term. If it's a building, you could have signed a lease agreement of 5 years or 10 years. So in that case, you cannot be evicted from that particular building before that particular period, unless you are not able to meet your side of bargain. Unless you are able to meet your side of bargain, then you cannot be evicted. But if you are able to meet, then you still own that particular place. Then you can also, we have also talked about buy decision. So you can also decide, instead of leasing, you can decide to buy that particular part. For instance, I'll ask you on this. If today, you know Kencom building? Kencom?
Yes,
Who is the owner of Kencom building?
I guess KCB.
The KCB are the former owners. Those are the former owners. So, KCB were the owners of Kencom, but they constructed the ABC Plaza, KCB Plaza, or thereabout. So they decided to sell off Kencom. Get it? Now, they could have still maintained that Kencom, but they considered that if they hold that Kencom, that building, it's valued a lot of money, and their business is not in holding a fixed asset in terms of buildings. Their biggest asset should be loans. So they opted to sell off that particular building Kencom so that they can utilize those money to give out as loans. Get it? Which will earn them interest. So in that case, that's what we are considering as a lease. So they decided to sell off the building, then they lease it. They are now tenants within that particular building. So that's also a source of capital. Then we have venture capital. Venture capital. Have you heard of women funds or youth fund? Have you heard of women fund and youth fund? Anybody who has not heard of,
Yes.
you have heard of those funds? Huh? Now, those funds were created by the government. And the reason why they were created is that the government, youth and women, one, they are disadvantaged. They don't hold assets. Because they don't hold assets, they cannot go to a bank and negotiate directly for a loan, a bank loan. So in that case, government had to take care to assist them so that they arise. But now one common feature for youth and women, they are hardworking and they're also trustworthy. They're hardworking and trustworthy. So as much as they're hardworking and trustworthy, banks cannot give you a loan on the basis of your trustworthy and hardworking. The banks will give you a loan on the basis of your ability to repay back. So in that case, that's why government had to come in and create a women fund and youth fund to finance those startup projects. So that's a kind of a venture capital that we are financing risky projects and we're giving them money to start off those risky projects, probably which could have not been financed under the conventional accounting or under the conventional banking system. Then the next one is a syndicate. A syndicate. And I had already told you about syndicate. This is where several banks are combining to give out a loan to a single borrower. Several banks are combining efforts to give out a loan to a single borrower. And I had given you an example. If today Safaricom wanted to borrow 50 billion, they have the ability to repay. They have their financial statement shows, their financial muscles indicate that they can pay that particular loan. But now considering the banking laws, no single bank can give out a loan of 50 billion. So in that case, they will only negotiate with one bank and request that bank to coordinate other banks so that they are able to borrow, or they coordinate other banks so that those other banks can remit or can indicate how much they can lend to that particular company. So Safaricom will get their full amount as 50 billion. They will have signed with only one bank, but now they know that loan is not for one bank. So that one bank will be receiving the installment payment from Safaricom. Then immediately they have received, they will channel those money to other banks. They will remit those installments to the other banks which have cooperated or incorporated into giving that loan. So we refer to that as a syndicate or syndicated loan. Syndicated loan. The last one is notes payable. Notes payable. Now, when you talk of notes payable, are written agreements or promissory notes in which one party agrees to pay the other party a certain amount of cash. That we are signing an agreement that we are going to pay you certain amount of money at a certain rate or on certain particular date. So I promise you that yes, you pay the offer me this service, I'll pay you on this particular date. For example, some of you could have used the promissory note. Some of you could have written an agreement with Kim that you just offer me the training service before I write my exam, or once I've written my exam, I'll come and before I collect my certificate or transcript, I'll have to pay you this money. So that's a promissory note you have given. There's an agreement that you have made, a commitment you have made that you're going to pay the amount of tuition at that particular date. So if Kim has accepted, then that's also a source of capital. That in that case, you will have utilized the resources or the services, but you will not have paid for them. So any question pertaining long-term source of capital or source of capital in general, whatever we have discussed, any question pertaining those, whatever we have discussed. Now, as if there's none, we want to do a small computation on those sources of capital. We want to do a calculation for source of capital, cost of capital. So just a minute, I display a certain question. You give you some few minutes, then we calculate the cost of capital. Are you able to see the question I've displayed? Yeah?
You
Yes,
stopped
please.
sharing.
Yeah?
You stopped sharing.
Yes, I stopped whatever I was sharing because that was a table, PDF
Yeah.
table. Now I'm sharing the cost of capital. Have you seen it?
Yes.
Yeah. So just for that question one, let me hide the other part so that you don't. I'll send you the other questions. We'll try one, then I'll send you the other questions and you'll continue. So I give you 2 minutes. You look into it. You write it down. Write it down, then we do it together. So 2 minutes. Yes, sir. Same to you. Okay, hello class. I hope you have written that question. You have written that question?
Yes.
Yes,
Yes.
sir. So we want to solve. Huh? Yes. Just a minute. Okay, sorry. So we have already. Joyce, confirm if you can hear me now. Joyce, can you hear me? Okay.
Yes.
Okay, so if you can hear me, that's good. So I had muted to allow you write that question, and I hope everybody has written that particular question. So we want to solve it. So the question is asking us to calculate the weighted average cost of capital. Now, for us to calculate weighted average cost of capital, we first of all have to calculate the cost of capital. So just a minute, I air my whiteboard, and then I show you how we'll calculate cost of capital. After that, we'll do the weighted average cost of capital, and then we'll be good to close that particular chapter. What now? Sorry, I was disrupted. So, for us to calculate the cost of capital, I'll first of all give you the formulas. Then from there we'll try and apply each on each. So, when you're computing cost of capital, we only consider long-term sources of capital. Remember, you have discussed about sources of capital, you have discussed short-term, and you've also discussed long-term. So we are only concerned about long-term source of capital. So the first one was equity. Who can remind us the second name of equity?
Ordinary shares.
Ordinary shares. Thank you. So the formula to calculate the cost of equity, KE is equals D1 is equals D1 over P naught minus F times 100 times 100 plus G percent. Then in your book write where KE where KE is cost of equity. KE is cost of equity. D1 is dividend per share. D1 is dividend per share. P naught is price per share. P naught is price per share. F is flotation cost. F is flotation cost. That 100 is to convert into percentage, so you don't need to write. That's to convert into percentage. Then G is expected growth rate. G percent is expected growth rate. G percent is expected growth rate. The second one related to equity is retained earnings. Retained earnings. Remember, we said the profit that organization make, they usually don't distribute the whole amount to the shareholders as dividend. So they usually keep part of it. So that whatever they have retained is what we are referring as retained earnings. So the formula for retained earnings, KE, is also use KE is equals D1 divided by P naught minus F times 100 D naught, D1 over P naught minus F times 100. Where you can write where KE is cost of equity, cost of retained earning. In this case, we are talking about cost of retained earning. KE is cost of retained earning. P naught is still price per share. P naught is price per share. D1 is dividend per share. D1 is dividend per share. F is flotation cost. F is flotation cost. Then that 100 is to convert into percentage. Yeah? Note this. Let me pick a different color so that I'm able to illustrate. The cost of retained earnings, the formula for cost of retained earning is more or less the cost of ordinary share save for growth. We have just picked the formula for ordinary share, only that you have not adding growth. We don't add growth to retain earning. So I hope that's clear. We don't consider growth when we are computing cost for retained earning. So we move on to the next one. We move on to the third one. Let's look at preference shares. Just a minute. Preference shares. Who can remind us the other name for preference shares? Preference shares. Anyone who can tell us the other second name for preference shares? Hello, class. Anyone who can remind us the second name for preference shares? Nimebaki peke yangu kwa darasa.
I don't see if there was something like that.
Okay. So on the list,
Yeah.
okay. The new we have discussed, that was as per the syllabus, what had been indicated on the syllabus, but it was not mentioned on there. But I'll still give you preference shares. It's also called quasi-equity. It's also called
Spellings.
quasi.
Spelling for that.
I'm writing.
Okay.
Have you seen?
Yes.
Quasi-equity. Now, with the quasi-equity, they are further subdivided into 8 categories. These are preference shares. Okay, the difference between quasi-equity and the ordinary equity or ordinary shares, that for ordinary shares, they form part owners. But for quasi or preference shares, they're given some preferential treatment. So with those preferential treatment, they're also bad. They don't participate fully as the ordinary shareholders in a company. So this category of shareholders, they have some characteristics of shares, and they also have some characteristics of loan or debt. The characteristics of shares that they do have, they are called shares. They are preference shares. They are shareholders. But now the characteristics of debt that they have or loan that they have, mostly they are paid a fixed return that will agree 10% or 20%. So that means if I've invested 10,000, then I expect at the end of the year, I should give me 10% of my 10,000. Not with regard to how much profit you have made. So they are given fixed return. So that's why we say they have some characteristics for ordinary for loans and also some characteristics for ordinary shares. They are drawn in between. And as I had mentioned, they are categorized into 8 categories. The first category, we have redeemable preference shares and non-redeemable preference shares. Redeemable preference shares and non-redeemable preference shares. So when you talk of redeemable preference shares, those are the shares that, okay, they are like loans. We have given you for a certain number of years. At the end of those years, the company must pay back those people, those shareholders, they must be paid back their money that they invested in that company. So that's why we call them redeemable preference shares. For non-redeemable, it's a long-term finance that the company does not have to pay back the shareholders. Then the third and fourth category, we have what we call cumulative preference shares and non-cumulative preference shares. Cumulative preference shares and non-cumulative preference shares. So for cumulative preference shares, these are the shares that if we don't make profit for a year, we don't have to pay dividend for that year that we have not made profit. But the year we'll make profit, we have to pay back the backdated profit dividend that we had not paid for the previous year. We have to clear the dividend in arrears for the other years that we had not paid before we can pay dividend for the current year. So that's why we refer to them as a cumulative. For non-cumulative, if we don't make profit, we don't pay dividend. but the year we make profit, we only pay for that year we have made profit. We don't have to pay in arrears. So that's what we refer as non-cumulative. The other category, which is now 6 and 7, we have participative preference shares and non-participative preference shares. Now, when you talk of participative preference shares, these are the shareholders or the shares whose dividend, as much as is indicated in percentage, but now that percentage is the minimum. So if the company makes higher profit, then these shareholders will also get higher returns. If the company makes lower dividend, then they cannot get below that particular percentage. So if you have agreed 10%, if the company makes high profit, you can give us a dividend higher than 10%, but now you cannot give us below 10%. So we refer to that as participating. Then we have non-participating. So for non-participating, these are preference shares that will only get the percentage that we had signed. They will only get the percentage that we had signed. So if we had agreed 10%, then it's only that 10% that we give out. So we cannot give out more than the 10%. So we refer to them as participating. The 7th and 8th, so a minute. The 7th and 8th, we have convertible preference shares and non-convertible preference shares. I said convertible preference shares and non-convertible preference shares. Now, when you talk of convertible preference shares, these are the preference shares that we can easily convert into ordinary shares. We can easily convert them into ordinary shares. For non-convertible, that we cannot convert them into ordinary shares. So those are the 8 categories of preference shareholders. But the formula to calculate cost of preference shares, we use KP. KP is equals DP over P naught over P naught times 100 times 100. DP over P naught times 100. Where KP is cost of preference shares. KP is cost of preference shares. DP is dividend on preference shares. Dividend on preference shares. Dividend on preference shares. P naught is price on preference shares. Price on preference shares. We move on. We had discussed about bank loan. Bank loan. Bank loan. And remember, the bank loan, we have short-term bank loan and we have long-term bank loan. So when you are computing the cost of capital, we basically consider the long-term bank loan, not short-term. So for bank loan, we use the formula KD. This D is to denote debt. KD is equals I into bracket 1 minus t. I into bracket 1 minus t. KD is equals I into bracket 1 minus t. Just let me write this one clearly because it looks like 4. That's okay. Where KD is cost of debt or cost of bank loan. KD is cost of debt or cost of bank loan. I is interest rate. I is interest rate. Cost of that's interest rate. 1 is constant. 1 is constant. T is tax rate. T is tax rate. T is tax rate. Just a minute, I connect my power. Okay, so the last one is debenture. Debenture. What did we say is a sister to debenture?
Bonds.
Bonds, yes. The sister to debenture is bonds. Bonds apply to government. Debenture apply to private public companies. So for cost of debenture is KD. KD is equals I into bracket 1 minus T, 1 minus T, close the bracket, PAR over D naught. Over D naught. Then we multiply by 100. Multiply by 100. Where KD is cost of debenture or cost of debts. Cost of debt or cost of debenture. I is interest rate on debenture. Interest rate on debenture. 1 is constant. 1 is constant. T is tax rate. T is tax rate. T is tax rate. PAR is face value. PAR is face value or market rate of debenture. Face value or market rate of debenture. D note is price for debenture or selling price for debenture. Selling price for debenture. Now, I would just like to explain something about PAR so that I don't lose you once we start the computation. Now, this is what usually happen. When we sell shares or when you sell debentures, there are three options. The three options are, just a minute, I write you those three. Sorry. The three options are PAR or par value. You can write it. You can write it PAR. Number two, at a discount. Number two, at a discount. Number three, at a premium. Number three, at a premium. So let me explain those three terms so that you are able to conceptualize them. When you talk of at par, that means we are selling the value if one share is selling at 10 shillings. Market value is 10 shillings. Then we are also selling additional shares at 10 shillings. So in that case, we refer to it, we are selling at par. We are not increasing any shilling or we're subtracting any shillings. They are selling at the same rate at which we have bought that, or we are selling at the same rate at which the current shares are selling. When you say at a premium, what we mean by that is that if at all the share was selling at 10 shillings, then the additional shares that we want to sell, we can decide to sell at a higher rate, let's say 12 shillings. So in that case, we refer to it as at a premium. We are selling at a higher rate than the market rate or the face value. Then number three, that's at a discount. One, we are not allowed to sell shares at a discount. By law or by ethically, we are not allowed to sell shares at a discount. Because if we were to sell our shares at a discount, then we'll be favoring the new coming shares, the new coming shareholders, but frustrating the existing shareholders. Because if at all the share was selling at 10 shillings, then we decided to sell new shares at 8 shillings, then automatically there's nobody who will be able to buy shares at 10 shillings. We'll devalue all the shares to 8 shillings. In that case, we'll have devalued the asset of the existing shareholders by 2 shillings, which is not ethically correct and also legally is not allowed. So we have to protect the existing shareholders. So in that case, when it comes to shares, we don't sell them at a discount. But when it comes to debenture, they are allowed to sell at a discount because you are borrowing money. If I was to borrow money from you and ask you to give me 10,000 shillings, I'll pay you next week or end month, you are likely to hesitate to give me that money. But if I tell you, give me 8,000, I will record as if you have given me 10,000. So when I pay you next week, I'll pay you 10,000, yet you give me 8,000. Most of you will be motivated to give me that money because of the returns that you're going to get. So when it comes to debenture or bonds, we can give them at a discount. But when it comes to shares, we can only give them at par or at a premium. So I've illustrated that. So now we want to go back to our question, and solve that particular question. Hopefully today we'll extend by 10 minutes, then we finish that question so that you will have gotten the concept. So in this question, they have given us, there are three sources of capital. First source is ordinary share of 20 shillings each. The second source is 50,000 10% preference shares of 10 shillings each. Then the third one is 40,000 10% debenture at 10 shillings each. So we want to try and solve this. Let's start with the ordinary shares. Ordinary shares. Our formula still remains KE. Start off with ordinary share. So ordinary shares, we said, it's also referred as equity. Equity. So if you hear equity, don't just assume it's only Equity Bank. So, and we said it's KE. KE is equals P D1 is equal D1 over P naught minus F times 100 times 100, then plus G percent. G percent. So let's substitute. Let's get from the question, who has identified D1? Dividend on ordinary shares. Anybody who has seen? Anybody who has seen the dividend? Okay, in the interest of time, you have seen 30 shillings? 30 shillings?
20.
Yeah?
Is it 20?
There's 20 and you have also seen on additional?
Oh, the market values ordinary shares
Yes.
30.
Yeah. So we'll subtract to get 10.
Okay.
So we'll use that 10. Okay, in some question you'll be given expressly the D1 dividend, but for this one you have not been given expressly, so that's why we have subtracted that. So do 10
Okay.
divide by P, price is 20, you have seen 20,
Yes.
minus flotation cost. How much is flotation cost?
It's 2 per share.
2 per share minus 2 times 100. Then plus G. So for this question, we have not been given information about growth. We have not been given about growth, so we don't have to include it. So we leave it aside. So calculate that and give me the answer.
Haki watu wameingia kupika chakula. Waongei.
Tufanye hii next week, si ndio? Wacha tu juu imefika 8:30. Wacha
No,
tuifanye
it's
next week
not
badala tusifanye na kwa haraka tuifanye next week, ndio?
Okay.
Sawa, but you can try to substitute and see if you can make it.
No, this was not meant for the class.
Eh,
Probably there are people there.
but the silence in the class also
Yes.
denote with the online inaweza kuwa mumesema ni mimi nikuwe radio presenter, wengine mumeenda kuona Zora, mnaniacha tu hapo najiongelesha.
Okay.
So, okay, or any other member apart from Rebecca who is still around who we can progress?
Nico.
Eh? Muko lakini amuongei. Sasa kama muongei na mimi si radio presenter, mimi ni mwalimu. So badala tuharakishe sana, naomba tufanye hii next week calculation.
Okay.
So, yeah. So because hata imefika 8:26 karibu 8:30 na kuna kama bado niko town nafaa kufika kwa nyumba mapema. So tufanye next week, tutafanya calculation. But what I request, kindly once you have done with the topic, with those questions that I circulate, kindly take some time, do them, so that you are able to come up with the questions. When we meet next week, you are able to come up with some questions pertaining whatever we had done, so that we solve before it's too late. Alex, I can see your hand is up.
I was requesting if possible to share this recording.
Yeah? Come up again?
I was requesting if possible
Yeah.
share this recording.
See, I shared the last week I shared and I've not seen anybody interested in looking at it.
Please,
Is there anybody who has tried to log in and check?
Yes.
Nancy, you have checked?
Yes.
So the others have not checked. So if it's me, I will share. But I cannot share on your WhatsApp because remember this class has taken 3 hours. So it's a huge document that I cannot circulate on WhatsApp. It will take the WhatsApp yangu itahang ikisubiri kusend. It's too large. So that's why I usually share on YouTube. Then I send you the link. Is that in order?
Yes.
So I will share on YouTube, Alex. So check.
okay.
Any other concern? Any other concern? So if there's none, I wish you a wonderful evening. Let's meet next week, God willing. Kindly go through, especially the questions that the topic you have already calculated, so that it gives us easier time, that you don't have pressure. I wouldn't like to have pressure in December, that you will have to do exam. It's when you are looking for how we are solving some of the questions. In that case, you will panic, and mostly students fail because they have panicked. So I wish you a wonderful evening. Let's meet next week, God willing.
Thank you.
Welcome.
Thank you. Bye.
Bye.